Basically, yeah, that insurance is just an expense and not part of the transaction strategy in general. Most owners focused on EBITDA growth in the buyer relationship, which is obviously critical, but they assume insurance is something the buyer will sort out post-close, where in reality it becomes a core diligence item. If there are gaps, exclusions, or messy claims history, it directly affects the deal. So, like in that case, it could be with respect to the purchase price, the size of the escrow holdback, the indemnity structure, or whether the deal even happens at all. So it's really not just a cost, it's part of the value and certainty of closing on a transaction.
Insurance is important for succession planning because buyers underwrite risks the same way that like insurance companies do. When a buyer looks at a business, they're asking, what could go wrong after I buy this? Or who pays for it when something goes wrong? How predictable is the risk profile for the cash flows I'm buying? If insurance is poorly structured or something's missing, if you're missing key coverage, then the buyer protects themselves by either lowering the price, increasing holdbacks or escrows, or they could walk away from the deal. Insurance and succession planning is really about removing uncertainty, and it's the fastest and most cost-effective way to do that. But it only works if it's addressed 12 to 36 months before a sale, rather than what we see sometimes is just 30 days before closing.
Insurance impacts like the valuation of a business in three main ways. It reduces the transaction friction. So by having like a clean loss history, modern upkeep on current policies, and proper limits make due diligence smoother and faster for a buyer. It would help lower escrow and indemnity exposure if the deal uses certain insurance products like representations and warranties insurance, environmental policies, and potentially even like errors and omission policies or cyber coverage. The buyer is less reliant on the seller guarantees. So like we mentioned before, that means you would see reduced escrows, faster payout to the seller, and less post-closing risk. And then thirdly, it would stabilize EBITDA. Large uninsured losses or volatility in claims can distort earnings. So properly structured insurance smooths financial performance, which buyers reward with higher multiples. So like we would often see the request to help in the negotiation process for a seller, and we would then review insurance policies. And in certain situations, there's types of policy structures that are not favorable for a buyer. That say you're working with like a manufacturing business, and there's product liability exposure. You as a buyer might not see issues right now, but issues that could arise in 3 or 4 years that could affect the acquisition or the company negatively from like an insurance perspective per se. So it could be either side, right? Like we would be able to structure policies from like a wealth management perspective for the seller. We can look at operational policies for the seller. We also can look and work on behalf of the buyer. So if the buyer's looking at a target company they want to purchase, they would ask us to come in and do due diligence on the acquisition. So we can work on both sides. We typically would get brought in through like the deal process, whether it's buyer or seller. If we're already representing the seller and they've prepped us, we would try to smooth things out, make things like essentially in a really good spot for them, so that when they're posing the sale, they look very good to a buyer. And then on the buy side, like we've definitely been in positions where we came in to look at target companies and frankly like seen a bit of a mess, and we've warned them like these are things you're going to need to address within the sales purchase agreement before you acquire that company, right? So we would be involved. I think people think that we're a last-ditch effort, but I think collectively it's equally as important as maybe the tax, lawyers, and advisors as well.
It will really depend on the company that's being purchased, and it varies by industry. So for example, If you are selling directly to consumers and you carry a lot of personal identifiable information, cyber insurance is going to be incredibly important. But in terms of most often, you're looking at your core diligence coverages, reviewing general liability, property and business interruption, auto exposure, umbrella and excess liability. And in a transaction, something that's also very important is directors and officers, and then addressing the risks kind of more on a industry specific basis, errors and omissions or professional liability, or emerging and deal sensitive risks. Like I said, cyber liability really important if you're carrying a lot of sensitive information, environmental liability if there's a big pollution exposure, product liability for businesses that deal a lot with physical product or completed work, employment practices liability is a big one as well. And in the deal process, buyers are less concerned about premium a lot of the time and more concerned during due diligence with gaps in coverage, limits that are too low, claims that weren't properly handled, and policies that won't respond after close.
Really, ultimately, like, you want to treat your insurance program like your balance sheet. It's not just an annual renewal. Like, there's ways that you can leverage your insurance to grow your business, whether that be in the form of like surety, bonds, like things like that. Like, you can use these products really to offset and transfer risk from your balance sheet, right? And you think paying for insurance policies in general is like the necessary evil, but these gaps in coverage can be fixed. These exclusions and like lower limits are something you can look at prior in lead up to a sale that really make you more attractive to a buyer.
The advice I would give for owners before selling is when you are starting to think about the sales process, part of that should be your insurance program and having that reviewed, making sure that your risk structure is in a saleable position 2 or 3 years away from a potential sale. Get an insurance audit from a broker, fix up the gaps and exclusions and limits, clean up your claims and reporting processes, and align your program with what a buyer might expect. And you can get that information from a broker who deals in transaction risk. You can also get good insights from your representative in the transaction. But the best time to address it is before you hire the investment banker or your deal rep, not after the LOI. Because once the deal is in motion, you're negotiating from a position of whatever risk profile you already have.